Right now, while the mainstream media is busy celebrating a minor bounce in the gold price, a billion-dollar machine is trying to convince you that the danger has passed. Serious. Stop what you are doing. Put the phone face down. If there is anyone in the room with you, tell them you need 10 minutes of absolute silence. Because what has transpired in the global gold market over the last 14 days is not a correction. It is not profit-taking. Pause. It is the most coordinated clinical liquidation of sovereign gold reserves we have seen in this century. Surprised gold just hit $4,400, but the story isn't the price. The story is the seller. It isn't China. It isn't Russia. It isn't a hostile adversary trying to break the dollar. It is Turkey, a NATO ally, a country that spent 5 years accumulating gold as a strategic shield. In the first 2 weeks of this Middle East conflict, they dumped 60 metric tons. That is nearly 2 million ounces of physical metal hitting the tape in just 14 days. This isn't a portfolio adjustment. This is a forced extraction. Tonight on Market Crux, I am going to show you the crime scene. I am going to show you how the Strait of Hormuz has become a financial noose, why the April 6th deadline is a tactical trap, and why $4,400 gold is a coiled spring waiting to explode. I'm not asking you to trust me. I'm asking you to look at the math. This is Market Crux. Let's look at the data. Let's start with the numbers that Bloomberg buried in a single paragraph. Between March 11th and March 25th, the Central Bank of the Republic of Turkey sold and swapped approximately 60 metric tons of gold. At $4,400 an ounce, that is $8.49 billion of physical gold liquidated in 2 weeks. Why would a central bank part with nearly 2 million ounces of the only asset that has survived 5,000 years of human history? Because they are staring into an energy-driven abyss. Turkey imports 93% of its oil. When the conflict in the Middle East escalated and the Strait of Hormuz was partially restricted, oil prices didn't just rise, they spiked 40% in 21 days. Turkey's current account deficit blew out instantly. Their currency, the lira, began to hyperventilate. To pay for the energy they need to keep their factories running, they needed US dollars. Fast. When you are a central bank in a corner, you don't sell your liquid assets. You sell what the world wants. You sell your gold. This 17% drop in gold we've seen over the last month wasn't a loss of confidence. It was forced selling. Gold is falling because it is the only asset liquid enough to function as an emergency lung for a dying economy. To understand the gold market, you must understand the geography of the Strait of Hormuz. 20% of global oil flows through this single passage every day. Iran controls this passage. When traffic is restricted, the global energy bill for every importing nation skyrockets. This creates what we call the energy gold inverse loop. As oil goes up, the demand for US dollars to pay for that oil increases. This strengthens the dollar index, DXY, which is currently hovering near 100, its strongest monthly gain since July 2025. A 2.3% move in the dollar usually puts a small dent in commodities, but we saw a 17% move in gold. Why the mismatch? Because it isn't just about the dollar strength, it's about sovereign desperation. Turkey is just the first domino. How many other central banks in Southeast Asia, Africa, and Eastern Europe are quietly dumping gold into the London vaults to pay for emergency energy imports? We won't see that data for months because reserve reporting has a lag, but Turkey is the warning shot. The market is currently betting on de-escalation because President Trump announced a delay in military strikes on Iranian infrastructure until April 6th. The media calls this progress in negotiations. Market Crux calls this tactical repositioning. You don't delay a strike because you want peace. Tehran has already rejected the 15-point ceasefire proposal. You delay a strike to move aircraft carriers, bomber squadrons, and submarine fleets into position. The 10-day window is a countdown to a shock event. We are looking at 3 clinical scenarios for April 6th. The capitulation, a miracle deal is signed. Oil drops 30%. Gold dips to $4,100 on safe haven outflows, then rallies to $5,500 as the Fed finally cuts rates. The strike. Negotiations fail. The U.S. strikes. Iran closes Hormuz fully. Oil goes to $180. Gold flash crashes as central banks liquidate more metal to survive, then rockets to $6,000 as the world realizes the dollar is no longer a safe store of value. The tactical gap. The strike happens before the 6th. The market gaps up $300 in a single night. If you are in paper, you get skipped. If you are in physical, you are protected. While everyone is staring at gold, silver is shouting the truth. This morning, silver jumped 2.9% while gold was up only 0.33%. Why? Because silver is the industrial nervous system of 2026. You cannot build AI chips, solar panels, or EV batteries without it. and the Middle East conflict is destroying the supply chain. Silver refining is a high-energy process. When energy costs spike 50%, the cost of producing a single ounce of silver paste doubles. Marginal mines are shutting down because they cannot afford the electricity. Combine this with the COMEX coverage ratio of 14%. For every 7 ounces of paper silver traded, only 1 physical ounce exists for delivery. China has already classified silver as a strategic material and restricted exports. We are looking at a physical deficit of 200 million ounces per year. The conflict isn't creating the silver shortage, it's just the match that lights the fuse. The strong dollar is a wrecking ball. The lira, the rupee, the naira, they are all being crushed by the combination of a surging DXY and skyrocketing energy bills. This creates the sovereign doom loop. A country needs oil. Oil is priced in dollars. The dollar is expensive. The country sells gold to get dollars. The gold price drops. The dollar looks even stronger. This loop continues until the physical floor is hit. We are approaching that floor. Central banks accumulated over 2,000 tons in 2024 and 2025. They bought it because they knew this systemic fracture was coming. They are now using that gold for its intended purpose, emergency survival. Once the selling stops, the reaccumulation phase will be the most violent move in monetary history. We are living through a repeat of the 1970s, but with 10 times the debt. In the 70s, gold went from $35 to $850, a 24 times increase. Back then, we had an energy crisis, geopolitical instability, and high inflation. Today, we have all three plus a fractured global supply chain. The $4,400 price point is not a peak. It is the base of the next mountain. If you sold your gold because it dropped 17% in a month, you fell for the oldest trick in the institutional playbook. You let a mainstream narrative separate you from a hard asset. The institutions want you to panic sell at $4,400 so they can buy your metal and hold it to $6,500. A warning to those holding paper ETFs. During a market dislocation, like a potential April 6th strike, the spread between paper claims and physical metal becomes an abyss. When the London vaults go into force majeure and the COMEX settles in cash, your paper gold is worth exactly what it is, a digital promise in a bankrupt system. The only real insurance is the metal you can touch. The April reckoning is 5 days away. The wind is picking up and the market is sitting on the edge of a cliff. The next 5 days will be the most volatile period of the year. The bullion banks are trapped, the vaults are bleeding, and the paper narrative is incinerating in real time. If you sold your gold, don't beat yourself up. You were fighting a billion-dollar machine designed to exploit your fear, but now you have the data. You see the 14% ratio, you see the 60-ton liquidation, you see the tactical delay, the paper burns, the metal endures. Do not let a 2-week shakeout undo a 5-year thesis. The trend is intact, the floor is set, the countdown has begun. I'm going to be very direct with you. The people who position themselves correctly during this shakeout are the ones who will build generational wealth. The people who panic sell because of a 17% move are the ones who will look back in 5 years and say, I knew it, but I did nothing. Don't be that person. If you want the clinical truth that the mainstream media is too afraid to report, you need to be part of this channel. First, hit the like button. It tells the algorithm that this data is essential, and it helps us break through the suppression filter. Second, subscribe to Market Crux. We follow the vaults. We follow the math. We don't follow the suits on television. The April reckoning is coming. I'll see you in the next one with the latest reserve data. Market Crux, signing off.